I'm Bobby Coates, a professor in the Department of Agricultural Economics and Agribusiness in the University of Arkansas Systems Division of Agriculture. Now joining us is Dr. Don Shurley. Dr. Shurley is a cotton economist and professor emeritus of cotton economics in the Department of Agricultural and Applied Economics at the University of Georgia. Don joins us to discuss two topics. First, cotton market outlook, and second, to provide a Farm Bill update. Domestically and globally, cotton producers, industry leadership, and analysts are keenly interested in Don's analysis and his insight into cotton market outlook, policy, and issues impacting the efficiency of the cotton industry. Dr. Shurley has few equals in his area of expertise. I give you Dr. Don Shurley on cotton market outlook and a Farm Bill update. Don, we look forward to your presentation.
Thank you, Bobby. It's a great pleasure to be with you today. Let's discuss the outlook, and then, as Bobby said, I want to spend a few minutes reviewing some of the main points, not all, but some of the main points with regard to the commodities title in our new Farm Bill. There's a lot of talk about the weakness in the market. Some talk of prices dropping below 70 cents. And that talk is not unfounded. That's a major concern that we have in the industry, and certainly as growers. In my opinion, the economic fundamentals that we face in this market are not all that bad. We're going to talk about some of the positive factors and some of the negative factors here in just a second. My colleague and well-respected market economist, O.A. Cleveland, did an article recently where he laid out some of the bearish and bullish factors. Excellent commentary. And if you haven't seen that, I would encourage you to go back and look at O.A.'s work. But the fundamentals overall are not that bad. I think that more than anything, this market's being driven by the uncertainty of things like the trade, the tariff situation, the data, lack of data, and fear of what could happen in terms of our exports. So, I think those are major factors that are in the market at this point. The fundamentals are not that bad. There are some concerns there, but I think the market's driven more by fear and uncertainty at this point. This is a look at some of the positive and negative forces, as I call them, that are out there. And a couple of things that I want to draw your attention to. We don't need to spend time in the limited time we have and go through all this. My view is, right or wrong, good or bad, kind of biased by my situation here in Georgia and what we have faced here in Georgia and the Southeast this year. And we'll talk a little bit about that. I know that many of you are from outside Georgia in the Southeast and may not care about too much detail with that, but we are going to touch on it. In terms of the positive forces, I think the U.S. crop is still largely uncertain. I'll show you some numbers here in a minute. USDA actually increased the size of the crop back in its December numbers, and that took the market by surprise, I think, certainly. The Georgia crop, as I'll show you in a few minutes, the Georgia crop is going to be down 1 million bales from what it was estimated at back in October prior to when Hurricane Michael hit. And I think the Georgia crop may likely get even a little bit smaller than what it's estimated at now. Among the other positive things, India, China, and Pakistan, in addition to the U.S., all have crops that are currently projected by USDA to be less than last year. That lower production in India, I saw a news release just this week, as a matter of fact, where Indian officials were projecting that the Indian crop was going to be less than what it's currently estimated at. Should that happen, that's a positive. You say, well, Don, why is that a positive? Because India is one of our major competitors in the export market, and it could open export markets for U.S. cotton, and certainly that would be beneficial given the tariff situation and uncertainties that we have with China. But the other thing I want to particularly point out that I'm going to spend some time on, look at the next to last item there, world use. World use is trending up. World use, if the current projection holds, will be a new record. But if you look over on the negative side, that's not the issue. World use could be a record. The negative part of that is that USDA's monthly estimates have lowered world use 3 consecutive months. Starting in September, it was lowered in October, lowered a little further in November, and lowered a little further in December. Now, these lower estimates are still records. That's not the point. That's not the issue at all. The fact is that these 3 consecutive months cause us to question whether we can hold and the stability of world use. We've got oil prices that are down. Are we going to get into a cotton versus man-made fiber sort of situation as we did for a long number of years? So there are positive and negative forces out there. Let's look at where the market's at. The market's up nicely today. Last numbers I saw, we were up 131 points. We're up at just over 74 and a half. The 73.55 you see there is yesterday. And, you know, you might say, well, Don, why do we look at these charts? Well, what you see is that we had what was thought to be some nice support up there around 76 cents. And even higher support up around 80 or 81. And we tore through right both of those floors and dropped down to the lower 70s, now trying to make some headway to come back up. But on this path back up, and again, prices are up nicely today, we're going to hit some resistance again at that 75, 76 cent level, and then certainly again at the 80 to 81 cent level. What does that mean, common sense wise, to the cotton grower out there? Look, if you're a cotton grower, I know everybody wants another shot at 80 cents and certainly 85. There's not a cotton grower out there that wouldn't say, man, if we could just make another run back to 80 to 85, then I'll be happy. I don't blame you. I would feel the same way. What you need to do, though, is think about the negative, potentially negative forces in this market and where that could take us. And one of the strategies you might consider, yes, we all want cotton to return to 80 to 85. But if we get up in that 75, 76 cent area, then maybe start to let some of the crop grow. Start to sell it off in portions. And then if the market goes down, at least you will have taken something better than what we have now on at least some portion of the crop. I think taking protection from our worst case scenario is something that we need to think about. These are USDA's monthly estimates. What I'm going to do with y'all today is what I typically do. I kind of show you some factors that are out there, and then I'm going to kind of take out a shotgun approach and try to hit a lot of different areas, and hopefully some of what we say and some of what we discuss today will be something that interests you and will be beneficial to you. So I'm going to take out the shotgun now and try to hit a lot of different areas. Look at the USDA monthly estimates. You can see that the crop, the total crop now is roughly 18.6 million bales. When you look at October versus November, we dropped off roughly 1.3 million bales there from the October estimate to the November estimate. 1 million bales of that was right here in Georgia. And then for the November estimate, USDA found some more cotton, improved the yield number a little bit, and up the crop. With that smaller crop, if you look down at the export line, we went from 15.7 estimated exports in September, dropped down to 15.5 in October, and now for November and December, USDA had us pegged at 15 million bales. You're going to see that when we get a smaller crop, okay? We knocked off over 1 million bales in the size of the crop, so it's not unusual and unexpected that we would trim off some of the exports because we've got less export supplies. And also, again, the continuing uncertainties with the tariff situation in China. This is a look at the yield estimates, and again, you can see what I talked about with Georgia. Back in October, our crop was estimated at almost 2 bales, 980 pounds per acre. And the last 2 months, November and December, dropped us down to less than 700 pounds. And again, based on what I've seen and talking with growers and some of our county agents out there, we could see that number come down just a bit more. I talked to an agent, for example, just a few weeks ago, and I told him, I said, what do you expect is the county average yield for irrigated and non-irrigated? This is a county that's very heavily irrigated, and it's certainly not unusual for irrigated cotton to average 1,200 pounds or more. And I asked him, I said, you know, what do you think y'all's yields will be this year? He said 300 pounds. I said, you're kidding. He said, no. He said, we didn't have hardly anything harvested, anything picked whenever Michael came through, and it's done nothing but rain since. And so that's further deteriorated the crop, further losses. And so I wouldn't be surprised to see the Georgia crop come down just a bit more. Another thing that has affected our yields and somewhat on fiber quality is that, and this is the last USDA numbers that were available, the last ones published this crop year in terms of harvest and crop progress. If you look just a few states here, if you look at Alabama, as of November 25th, they were 78% harvested compared to 86 normal. If you look at Georgia, we were 72% harvested versus 81. It's a little hard to see right above that, but if you look at California, California was only 80% harvested versus 92% normal. And then if you drop down to South Carolina, only 65% harvested as of November 25th versus 81% normal or average. And for the total U.S., 7 percentage points behind normal. So harvest delays can result in not only further yield loss, but certainly fiber quality loss as well. So these are also concerns. I want to take a little bit of a look at the demand side. One of the things that is certainly positive, if you look back at the bullet list that I gave you, world stocks have made significant progress trending down. If you look back at 2014 at the high, we had world stocks of almost 110 million bales. As everybody knows, most of that in China. But if you look at where we're projected to be at the end of this 2018 marketing year, down around 83 to 85 million bales. So tremendous decline. Now, stocks are still relatively high by historical standards, but stocks have moved in the right direction. That's a positive. World use or demand for cotton since 2011 has trended up. That's a positive. So, it's like I said, though, there are some positives in the fundamentals out there. And you say, well, Don, why are prices so bad? Well, because there's a lot of uncertainty about the demand side. There's a lot of uncertainty about our exports and our export potential here in the U.S. And until some of those things get better known, until they get squared away, the market always discounts fear and uncertainty. And prices will move in more earnest up or down once we get into a mode where we've got a little more certainty about what's going to happen. This is a look at world use or demand. And again, you can see the nice uptick that we've had since the low back in 2011. We're currently estimated at 125.6 million bales world use. That would be an all-time record. But I draw your attention to the blue box there and look at what has happened in terms of the monthly estimates put out by USDA. If you look back at August and September, they were estimating world use at almost 128 million bales. But then we had reductions down in October, November, and then again in December. Now that December number is still a record use, but the fact that we've been revised down now 3 months in a row causes concern in the market and cautiousness in terms of whether we can sustain this type of growth. And that is one of the things that is being factored into the market right now. This is a chart that shows us use by country since that low in 2011, and I think this is very telling. This is one of the most important things that I think I've got to share with you today. We have seen that growth, nice trend back up since 2011. But where does it come from? I think this is very important, and this is significant to our outlook in terms of where prices can go, not only now, but potentially in the future, depending on what directions this tariff situation and the overall situation with China goes. I want you to look at this. This is some of the numbers that are behind that chart that I just showed you. And I think this is very telling. And this is what's important here. That first column, million bales, this is the change in use by mills in these countries since the low in 2011. And then the change that million bales is as a percent of where the country was back in 2011. Look at China. China always gets the news. Compared to 2011, the most recent estimate, the current estimate for the 2018 crop year by USDA puts China using 3.5 million bales more than it did at the low point back in 2011. That's a 9.2% increase since 2011. Look at Vietnam. Vietnam has increased their usage of cotton almost 6 million bales since the low in world use back in 2011. That's almost a 350% increase in use. Look at Bangladesh. Increased 4.3 million bales for over 100%, over a twofold, in more than a doubling of usage of cotton since 2011. You look at a country like Turkey, who is among our top 5 export destinations. Their use has increased 25% since the 2011 low. And then that last column is the country's percent, what percent of that country's increase accounts for the whole world increase. And you look at places like India, Bangladesh, Vietnam. If you take those 3 countries alone right there, that's almost those 3 countries, India, Bangladesh, and Vietnam, those 3 countries alone explain about roughly 3/4 of the increase in world use since 2011. That's significant. Is China important? Absolutely, absolutely. But these other countries are also important, and our exports are going to depend on us being able to tap those markets, which we are, continuing to increase our exports and market share into those countries. And particularly since the future with China is unknown with the tariff situation, being able to increase our exports and market share with these other countries is particularly crucial. And so I wanted to show that to you. I think that's a very telling situation. This is what we did last year in terms of our exports. And again, I'm just doubling down on the importance of what I'm trying to say here. But last year, the 2017 crop year, Vietnam was our top country of destination with just over 3 million bales. That was followed by China, Turkey, Indonesia, and Pakistan. So right now, again, with the importance of these countries and these countries being such a large percentage of what we do in the way of exports, China, again, even though we've had import quota with them, even though they've limited their imports from the U.S., Turkey is a major buyer, Indonesia, Pakistan, with the uncertainty associated with China. And also, and again, I read this in the media over the past month or so, Turkey has had some uncertainty and some issues with their economy and with their currency that makes imports more expensive. The uncertainty with the Turkish market, in addition to China. These are all things that are factored into where we are now and where we're going to go with regard to exports. To look at where we are now so far in the 2018 crop year, this data goes back as of December 13th. That's due to the government shutdown. This is the last data that's available, and that has their export sales. If you're not familiar, the National Cotton Council does a fantastic job with this data. You can go to the Foreign Ag Service and you can find the export reports weekly on the FAS website, but they're rather difficult to decipher through. The Cotton Council does a great job of putting these numbers together, and that's where I've pulled them from. And you can go to the National Cotton Council's Economics and Prices section and find the weekly export data. That's very helpful. But this goes back a little over a month ago now to mid-December. and shows you where we were in terms of sales and shipments. That dotted line goes out to 15 million bales, which is where we'll need to be at the end of July, the current marketing year. And you can see that sales are pretty much on pace, or at least were. Shipments are well behind the pace that is needed. Actual shipments are well behind the pace that's needed to meet that 15 million bales. And but shipments are really on about the same track as they were last year this time, despite the fact that they're behind what's needed. They're about on pace with where they were last year. But we need shipments to pick up, and they will as we get later into the year and we have more cotton available in the warehouses to ship. But right now we're certainly falling behind pace in terms of the shipments that we need to meet USDA's 15 million bale estimate. I'm not going to go through all of this. I want you to focus just on that bottom bullet item down there that's in the box. The impact of the tariff and the tariff situation with China, as I've said, is largely unknown. One of the things that could happen, and this is very important, and it's why I talked so much about Vietnam and Bangladesh and other countries. If because of the tariff situation we lose some of our export market going into China, if that happens, that could result in only what we call a shuffle among other countries. In other words, if we lose exports to China, maybe we increase exports to places like India or Vietnam or Bangladesh. Maybe we increase exports to Vietnam, for example. The mills in Vietnam manufacture that into yarn, and then the yarn is sold to China. U.S. cotton ends up in China indirectly. One of the things that will be important as far as assessing the impact of this tariff situation with China will be, can we increase markets and exports to other countries to make up the difference? If the world demand for cotton continues strong, and like I showed you, we're at a record level. If the use or demand for cotton remains strong, then there'll be a demand for U.S. cotton. And U.S. cotton is going to find a home somewhere. We have to hope that if it's not China, if our exports to China are hurt by this, we have to hope that we can increase our market share and our exports to destinations in other countries to offset that. And most of the work and analysis that's been done out there in terms of trying to assess the impact of the tariff, a lot of it has to do with, can we increase market share elsewhere to make up the difference? And that's a big unknown, but it's something that'll be important, very important moving forward, depending on which direction that tariff situation takes. A look at weekly exports and sales. Shipments are, again, as you can see, we've kind of trended down weekly in terms of shipments. I showed you all the cumulative amounts to date as of the middle of last month. This looks at it on a weekly basis, and you can see that we've kind of trended down, but we've kind of held in that 150 to 170,000 bales a week level, but that's lower than where we were back earlier in the marketing year. Our sales, weekly, what we call net sales, Our weekly net sales have picked up, but as you can see, we've had some weeks that are fairly low. We even had 1 week back in October that was actually a negative. We had some cancellations, so our net sales was actually a negative number. But our weekly shipments have kind of plateaued out at a little lower level than where we were earlier. And again, the sales have come back from the lows that we had back earlier in the fall, but still just wide swings. We'll have tremendously good reports some week and then disappointing results the next week. And that's part of the uncertainty with this, and that's affecting the market. So it's not that our sales are not good. We've had good weeks, but we've also had some very disappointing weeks in terms of the numbers. So that's affecting our prices. So where are we with the rest of the 2018 crop? And again, I'm a little biased from the standpoint of where I'm coming from and kind of what I deal with here in Georgia a lot. So my view is kind of influenced by that. I think most growers were likely a third to a half priced. I know a lot that were. But unfortunately, whenever Hurricane Michael came through, what you thought was a third price ended up to be 3/4 priced because your production was cut so bad. Some producers were able, and fortunately, were able to get out of their contracts. The bad part about it is those contracts were well above where we are now. So if you cancel contracts because you couldn't deliver on them, that means that, not only do you have to deal with lower yield, lower production, but you have a much lower price opportunity now in the market than you did when you made those contracts to begin with. As we've talked about, the outlook is somewhat bearish due to uncertainties. I'm not going to jump off the ship yet. There are some concerns. Some folks are talking cotton below 70 cents eventually. I'm not ready to be part of that camp yet. That is a concern, however, and I think it's something that as a grower you want to guard against. So the outlook does have some bearish tendencies, but at the same time, I look at the nice increases we've had the last couple of days, and it kind of gives me hope that maybe this market can find some support and get back to a level that will encourage some growers to jump out and start pricing again. I think if we get futures back to the 75 to 77 cent level, is that what we want? No, I know it's not what you want. You want 80 to 85, and I don't blame you. I would agree with that. But because there is so much uncertainty and there is a tendency in this bearish market for prices to move lower, if we do have a move back to 75, 77 cents, I think I certainly feel like that would be an opportunity to take a little, some portion of your uncommitted crop and price it at that point. But in this environment, particularly, waiting is risky. You say, Don, you tell me to wait to 75 to 77. That's right. But we also realize that in doing that, you risk this market going to 70 or less. And so waiting is risky. But I think, if you the best thing to do, or one of the things to do is to, and that's why it's important not to sit back and wait on 80 to 85, because we may not get there. Certainly if we get back to 75 or 77, to reduce the risk on everything that's uncommitted at this point, price some of the crop on those advances to reduce the risk that you would have otherwise on everything. Let's look at the 2019 crop. We were at 74.2 cents yesterday. I looked at the markets this morning or earlier this afternoon. We're just under 75, so we were up 70 points from yesterday's close at the time that I looked at the markets before our broadcast earlier this afternoon. We've got some support, as we call it, down there around 72. Where do we start pricing? Where do we start pricing on the expected 2019 crop? Right now, I would set two targets. One at 76 and another one about 78. Anything up in that 76 to 78 cent area on December futures, I think is an opportunity to do some pricing. Do you want to do, how much do you want to do? Well, whatever you're comfortable with. But there is a lot of uncertainty, even more uncertainty about where this 19 crop price is headed as opposed to the current old crop price. Potentially the 19 crop is more of a concern, I think, than the current 2018 crop price. So you need to think about at what levels you want to start taking protection. Are we happy at 76 to 78 cents? No, certainly not. But given the uncertainties out there, though, that would be a level where you could start locking in some prices for this 2019 crop. Prices that are going to factor into planting decisions next year. Other crop prices relative to cotton, I'm going to show you some stuff on that. Peanut contracts, availability and price. Our peanut acreage, for example, here in Georgia was down this year. If cotton moves lower than it is now, that could send some cotton acreage shifted toward peanuts. We'll have to wait and see what happens to the price of cotton and what the contract prices are on peanuts, where they come out. And again, you can see the other things there that are going to factor in. This is a look at just relative prices, and I'm comparing corn and soybeans to cotton, what we call relative price ratios. If you look back at last winter and spring, when farmers would have been making planting decisions, you could see that corn to cotton ratio averaged over 5, about 5.2 to 5.3. And then if you look at soybeans to cotton, that ratio averaged about 13.3, 13.4, somewhere in there. That was where they were last year during the planting season. If you look at where we are now, and this was as of a week ago, again, December around 74 cents, corn around $4, soybeans at $9.61. That was a week ago. That corn to cotton ratio is now 5.4. What that means is corn's gained a little bit of ground relatively to cotton when it comes to price. So the corn price has gained a little bit relative to cotton. We were at 5.2 to 5.3 last year. If you look at soybeans to cotton, that soybean to cotton ratio right now is 13. That's lower than the 13.3 to 13.4 that we had last spring. What's that mean? It means cotton has gained relative to soybeans. So corn has gained ground price-wise relative to cotton. Soybeans has lost ground relative price-wise compared to cotton. A lot of discussion already about potential production for the 2019 crop year. We planted just a tad over 14 million acres of cotton in the U.S. this year. This table you're looking at shows you what the potential production is for 2019 out there based on the acres that we plant, based on the yield, and based on the abandonment. We had, I think it was 26% abandonment this year. But I'm looking at three levels, 10, 15, and 20%. You say, well, Don, that's a lot of numbers there. What do they mean? The numbers that are in pink or orange, whatever color it's showing up, those numbers are a higher crop than what we had this year. The green boxes are combinations that would give us an equal to or lower crop than what we had this year. And you say, well, Don, what are you saying? What I'm saying is nobody knows what's going to happen, how much we're going to plant, what the yield's going to be, and what the abandonment's going to be. But if you look at that box, most of it's orange. Most of it's pink or whatever the color is. That means there's a good likelihood, regardless of what happens, there's a pretty good likelihood that we're going to end up with a larger crop than we had this year. And if we do, again, depending on where we are in terms of the tariff situation, the export situation, the world demand, the usage situation, a larger crop in combination with some not so nice things out there with regard to demand and exports is going to send our prices lower. That's why I'm saying that, one of the things you might want to do is, start taking a little bit of protection if this market, December 19 futures shows some strength over the next several months. I want to spend a little bit of time talking about the Farm Bill. This is just a bullet list of kind of some of what the main changes are. And I'm going to spend some time a little bit talking about PLC specifically. But let me just run through these very quick, and hopefully we'll have some time for questions. The new seed cotton program's going to be continued. The PLC reference price on seed cotton is 36.7 cents. Your seed cotton yield, the actual seed cotton yield that will be on the county level, for example, for ARC, will be the county's cotton yield times 2.4. So the actual seed cotton yield will be whatever the cotton yield is times a factor of 2.4. But the seed cotton program's continued, the reference price stays as it is. If a farm is enrolled, the key word there is enrolled. If a farm is enrolled in ARC PLC for seed cotton, that farm's not eligible for stacks. All right. You have to elect ARC or PLC during this current enrollment during this current ARC PLC selection period. You have to elect a program, but enrollment you have to do annually. That's the same as we had to do under the current 2014 Farm Bill. You had to select ARC or PLC, but then whether you participated in it every year was a matter of being enrolled. If in any given year a farm is enrolled in ARC PLC, that farm is not eligible for stacks, okay? For seed cotton, any unassigned base will remain unassigned and not eligible for ARC PLC. There's nothing in the Farm Bill language that designates what will or will not happen with regard to unassigned base. The cotton loan remains at 45 to 52 cents as it was in the previous Farm Bill. It'll be tied to the adjusted world price just like it was in the previous Farm Bill. The change is that any reduction in that loan rate, again, it can vary between 45 and 52 cents. The difference now is that any reduction in that loan rate from year to year can't be more than 2%. Y'all would recall, not this past year, but I think 2017 crop, the 2017 crop, the loan rate was down to 49 cents and change. It can vary. It can still vary between 45 and 52, but not more than, can't be reduced more than 2% a year. The loan rates for most crops have been increased to reflect our higher markets over the past years. But this is with the exception of cotton and peanuts and some of the minor oilseeds. But the loan rates for most crops, with the exception of cotton and peanuts, was increased in the new Farm Bill. The reference price, which is used for PLC, and it's also used as an annual plug-in for ARC. In ARC, if the market year average price in any year is less than the reference price, then we plug the reference price in and use that. Reference prices are the same as they were in the 2014 Farm Bill. The difference now is you're going to have something called the effective reference price, which is going to be that reference price under the 14 Farm Bill or 85% of the Olympic average market year average price for the previous 5 years. And it can't be more than 115% of that statutory reference price. I'll show you a table on that here in just a second. Starting this year, producers may again elect ARC or PLC on a crop-by-crop, farm-by-farm basis. You're going to make an election this year. Do you want ARC or PLC? That election will be good for both the 19 and 2020 crops. And then beginning with the 2021 crop, you'll be able to make an ARC PLC election every year for the remainder of the Farm Bill. Landowners will be able to update your PLC payment yield. Your PLC payment yield on the farm right now is what you had under the 08 Farm Bill, or the average between 2008 and 2012, 90% of the average between 2008 and 2012. Beginning with the 2020 crop year, landowners will be able to update that PLC payment yield if they want to, and the update will be, if you choose to do so, would be 90% of the average for 13 through 17. Okay. Payment limits stay the same. Peanuts maintain their separate payment limit. Marketing loan, LDPs, and market loan gains are excluded from the limit. Previously, the deficiency payments, loan deficiency payments and market loan gains were included in that limit. They no longer will be. They're excluded. No changes in the AGI and actively engaged rules. And they did change the definition, expanded the definition of a family member in terms of actively engaged. Try to explain what's going on with the PLC. Let's take corn for an example. The reference price on corn, for example, PLC reference price is $3.70. That's what it was in the previous Farm Bill. If we take 115% of that, that's $4.26. The reference price can go up as high as $4.26. The statutory amount's $3.70, but it's allowed to go up as high as $4.26. Okay. In order to get that $4.26, the Olympic average, market year average price would have to be $5.01 per bushel. So if we have an Olympic average price of $5.01 on corn, that would give you that maximum. That's what it would take to get you that maximum effective reference price. And then that last column there on corn, for example, $4.35, the market year average price would, the Olympic average market year average price would have to be $4.35 or better to begin to increase it above $3.70. So basically, if you look at this table, basically what it means is having this, what we call an escalator clause, is great. It's a good thing, but in order for the farmer to really benefit from it, we're going to have high prices for a fairly sustainable number of years in order for that statutory reference price to for the effective reference price to be anything much greater than the statutory amount. Lastly, we've had a change in the loan rates. I told y'all that the loan rates have been increased with the exception of cotton and peanuts. This is what they were. You see corn's gone up to 220 from 195, and then soybeans up to 620, wheat up to 338. Very lastly, this is just a look at where we are currently on the seed cotton PLC. We just went through a period of time where producers had to decide between ARC and PLC for seed cotton. This is where we are right now. If you look at the bottom line down there, the PLC rate on seed cotton right now, the projection is 1.4 cents per pound. So if you would want to know how much you would get on PLC for seed cotton, for your seed cotton base, 1.4 cents times your seed cotton PLC yield. Okay. But that's where we are now based on currently projected prices by USDA and current production estimates on production of both cotton and cotton seed by USDA.